is he does a lot of the software companies, works with a lot of the software companies that Advanced CFO works with, and has some great experience there. He went through a model with me about the different stages of a company as they're growing. And I thought that would be really interesting in terms of just understanding how best to manage some of the financial questions that we may have as a company goes through different stages, and then how we can use that in our businesses. So Rob, without further introduction, I'll let you fill in any gaps that I have there. And then if you want to take over the screen, I think you should be able to share your screen if you'd like to show us anything, but otherwise I'll let you jump into what you've prepared.
Great. Yeah, just going along with what Taylor said, I thought after I talked with him the other day, it'd be interesting to go through a couple of metrics that I use with software companies. It's kind of a unique business model, and they go through a different life cycle than what a traditional business. Earlier in my career, I worked with more of manufacturing type companies, but the software company kind of is an interesting business model. So there's a couple metrics that I look at. One is operating leverage, which is the main focus of what talk about today, and then I kind of one that goes along with it is just the concept of coverage. So these will make more sense as we go along, but essentially what operating leverage is looking at the relationship with how fast is revenue growing compared to how fast are the operating expenses in the company growing, and what kind of leverage are you getting in the business. So if we go to this next slide here, I broke up software companies into a handful of different, what I think are discrete phases that they're in. So the first one is the startup. They have no product to start up until they have an MVP product. Then they go through, generally once they launch one and as the product begins to fit the market, they go through what I'd call hyper growth, which a lot of that's just attainable because if you have 100,000 in revenue, and now you have a 300,000 the next year, and it's a huge growth rate, but not necessarily in absolute terms. There's not necessarily a lot of revenue, but it's easy to have, 300, 400, 500%, or even 1,000% growth rate when you're starting out with small revenue. So there's that hyper growth, and then there's a phase that I call rationalization, and that's where companies in the software space can get into trouble if they're growing their operating expenses too quickly and the revenue isn't keeping up with it. And that's where I see a lot of them struggle, is trying to rationalize the business. There's a ton of pressure on software companies to grow really quickly, and a lot of times that means they're bringing on expenses so fast that the revenue just doesn't keep up. The next phase would be high growth, where it's usually, I've put in here rough estimates kind of to illustrate where those growth rates would be. So once the company's rationalized, they still should be able to growing fairly quickly in maybe that 75 to 100% growth rate. And then they go into growth inevitably as you get bigger and bigger, it's harder to come by new revenue. So it starts to slow down, and eventually they get to a scale model where they're more focused on profitability, and maybe they're growing 10 to 20% a year. So where operating leverage starts to fit in here is looking at that. How do you manage your revenue growth and your operating expense and not get out of whack? And the key point, I think, for success with the software business is really focusing on this rationalization period. And it's that time where you're letting revenue catch up with your expenses. And then a concept that I call coverage, which is, let's see, if this is illustrating it down here at the bottom. If you have a company with ARR of about 100,000 a year and their operating expense, say at $1 million, you only have about a 10% coverage. So your revenue is only covering 10% of your operating expense. And so the rationalization period is this time where you're trying to let revenue catch up. And so I would say somewhere in that 80 to 100% coverage of your operating expenses, while still being able to grow in that 75 to 100% or more, is really where you're trying to get the company at in that rationalization phase. If you focus too much on profitability, they're not able to grow at those, double digits or triple digits if they're not spending enough money. And so it's this balancing act. But where I've seen companies get in trouble is they'll have revenue, say down here in the 100, 500, and they've already created a business with 3 to 5 million in operating expense. And even if they're growing at, 200, 300% a year, if they keep adding expenses out, it takes a long time for that business to rationalize. And so that's where this concept of operating leverage and managing it the whole way through comes in. Before I flip to the kind of a demonstration on how you'd look at this in an example, does anyone have any questions before I move to that?
Yeah, this is Guy Latender. I think this is awesome. A question that you raised, and maybe you'll do it on the next slide, so I apologize. You talked about growth rates versus the numbers themselves. So that, I think, is what you're hinting at, is the rate of growth of those. How do you calculate those, if unless you're showing that on the next slide?
Yeah, I'm showing that here. So the calculation, this is just pretend numbers, but if you have up here at the top, I'll highlight this. If you have your ARR and then your operating expense, you can see here. So if you have, in this case, ARR grew at 300% from 250 to $1 million. And then if we look at their operating expense, it grew at 165% from spending 825 to 2.1. So the operating leverage is just dividing those to see the relationship. And so you want the company, once you get to an MVP and you have a product, pretty much you always want to have revenue growing faster than expense. Naturally, at the beginning, expenses are going to be growing faster than revenue just because you have to build a product, you have to have salespeople, and so naturally your expenses are growing faster. But once you get to a product level, you want to start managing to where your revenue is growing faster. And that way, every year, you're getting closer to that break-even point. And so generally, you're going to see this number change over time, and you're going to have a period. I've seen investors come in, they like where the company's at, but they just don't like where the coverage is. So say it's 60%, and they just don't feel comfortable that the business is only covering 60% of spend. So they'll force the company, say you just can't grow your operating expenses for the next 4 to 8 quarters. You need to put have a very slow growth rate and let revenue catch up. Otherwise, you get in a position where it gets harder and harder to fund the business. And then a thing I wanted to point out here is that once you get to scale, you can no longer have any operating leverage. So in this case, if the company at scale had, say, a 15% cost of goods sold, but 30% of revenue was going to sales and marketing, 22% to R&D, 12% to G&A. So their scale business model is, say, a 21% operating profit. Even though they're growing, you can see up here that revenue is growing at 15% a year. The scale you can't get any more scale because these metrics grow with the new revenue. If all these percentages stay the same, that means they're growing at the same rate. So the only time you're getting operating leverage is from that time of MVP until you're at scale. And the rationalization period, you want to intentionally have a period where you're getting really high operating leverage, where if we go back to here, you might have a period where they say, you know what, we're already at 2 and we want to get to 100% quicker. And so you want to, maybe this is 225, and it just allows you one period where you keep the growth really low in your operating expense, and even though you may be doubling in revenue growth rate. That makes sense. So down here below, what this graph is illustrating is that this upside down period where expense is higher than revenue, that gap has to be funded through debt or equity. And so the faster a company can get, they keep this narrow so that they're growing the cost closer to what revenue is and staying in scale. and the faster they can get to kind of a break even, obviously the better. And the easier it is to fund those businesses. It's when, if you graph this out and there's a big disconnect between spend and revenue, it's going to take much longer to fill that gap, and it's going to be more expensive in terms of investors and then what they're willing to, if they're willing to fund it at all, or on what kind of terms you're going to have. And so I've seen software companies as clients that, or others that they've let the operating expense take off way too quickly. I've seen them where they have, you know, 500,000 in recurring revenue, but their cost structure was close to 5 million. And I think they get out of whack like that because people get excited about the potential of the product and they start building out too quickly, and the revenue just doesn't have time to catch up. And inevitably they end up having to go through letting people go and rationalizing the business through cost structure rather than letting revenue catch up. And so the earlier a software company can think about these and manage and to create their budget around managing this metric, the more they can avoid those type of painful situations, and the easier it is to get funding. So anyway, that's I think the overview of the concepts of operating leverage and coverage. But happy to answer any questions anyone has.
Thanks. That's awesome. One quick question on this model. Are you willing to share this with the group, the Excel model that you've created here?
Yeah, I could send it over to you if you want to send it out to everyone.
Okay, great. That would be awesome. What other questions does the group have? Feel free to unmute yourself and throw some questions down.
Hey, Rob, this is Jake. I was curious if you could talk to us about some of the timelines that you've seen with both the manufacturing and the software companies, from like the MVP, like early stage startup, to that kind of rationalization time period that you were talking about. Like how long did that take with some of these companies? How long did it take with some of the ones that were successful, and maybe, you know, like some of the ones that weren't successful? Just because I'm curious, like, you know, obviously the sooner you can get to that rationalization, the better. But, you know, I feel like there's companies these days, like, you know, you look at a company like Facebook that took, you know, forever to start really making a lot of money. And obviously still around, they're still in business. But then, you know, I can imagine, you know, if you're looking for funding and, you know, that rationalization period isn't coming and you're not a Facebook, like, you know, that funding may dry up pretty soon. So if you could just kind of talk about the timeline and what you've seen with some of the companies that you've worked with, about how long it took from like the get-go to where they could get to that rationalization period with both the software and the manufacturing, that'd be great.
Yeah, I've seen them kind of across the spectrum. So I've had a client that the guy started the business on the side. He was working for Salesforce actually, and then he wrote a software on the side, started selling it, and he bootstrapped it all the way to $4 or $5 million. And he never was upside down. So he always managed, he managed it all the way through. But then I've seen the other extreme, like the one I mentioned, where they had about 500,000 in revenue and close to 5 million in expenses, and they really struggled. But most of them, I'd say, it somewhat depends on the difficulty of the market they're going into. So I have a client that is selling into very large enterprise, and the software is disrupting key components of their business. And so naturally, if you're going into big companies like that, they're not just going to let you come in without a product that really is working well. And so they had to spend a lot to get to the point where they really had an MVP. So their cost structure got up to maybe $4 or $5 million pretty quickly, but the revenue is maybe in the $1 million range. Whereas ones that don't have, the product doesn't need to be as perfect as one in that scenario, then they can start to focus on rationalization closer to maybe $1 million to $2 million in cost structure. So I think at first, how I would think of it is I'd look at the client, I'd say, what is it going to take to get to MVP? What kind of spend and R&D and everything like that to get there? What kind of infrastructure do you need to serve the client? And that's where I'd start that benchmark to say, okay, once you hit MVP, then you really should start focusing on revenue growing very rapidly, and you should be getting operating leverage, I'd say 4 to 10 times. So if you're growing at 100%, you'd want costs to be growing at less than 20% a year, and really get a lot of operating leverage and just give the time for the revenue to catch up. So that's how I would think about it, is first of all, look at what kind of infrastructure do you need at an MVP level. And once you get there, try and keep costs growing as low as possible while revenue catches up. So that's where an operating leverage of maybe the 4 to 10. But then once you're rationalized, then I think a healthy operating leverage would be somewhere between 1.3, maybe 1.7, because you want costs to stay growing with the revenue, because you don't want the customer to have bad experience with the business and the product. And so the only time you're doing that huge constraint is while you're rationalizing and you're just to keep the company financially sound, but maybe that 4 to 10 in there. But I don't know if that helps with that question. But
yeah, definitely. Yeah, and it's a bit of a balancing act, right?
Right. Yep. Any other questions or thoughts?
I guess one other kind of follow-up question too is some of the differences between the manufacturing and the software. And I can kind of almost see a case where manufacturing would get more out of whack than the software, but at the same time, I've seen software expenses get really out of control really fast as well. I was just kind of curious if you could comment on that.
Yeah, the manufacturing companies are interesting just from the standpoint that usually you can start selling a lot quicker than you can with a software company, where software you have to go out, build the product, and then you're going to get tons of leverage on that product. Whereas with a manufacturing company, to me, it seems somewhat easier to manage that scaling process. That you can launch a business model closer to profitability, or know where your break-even point is a little bit quicker, easier than a software company. Or you can have you can change your business model over time. So you might have in the beginning stage of a manufacturing company, you might outsource production. And so you have a 3PL, you have OEM manufacturing. And so you can you can tailor your cost structure to where you're at in revenue. Whereas with a software company, you have to go build. You can't leverage something already out there and then gradually build a new software. You have to create the software, then go out and sell it. Whereas with a manufacturing company, theoretically, you could just go to an OEM manufacturer and say, here's what I want. And you could say, well, I want to start out with 5,000 units. And you can just start at whatever point, and then you could tailor your cost structure to match where your revenue is at. I think a little bit easier than with a software company. And then with manufacturing, eventually you could take all that manufacturing in-house if it made sense as you grew and you got to a point where to break even, you needed, say, 1 million units a year. But in the beginning stages, you can't, unless you have the funding to build out the infrastructure to support 1 million units, you're going to have to fund that for quite a while. Whereas if you go with an OEM or something, you might be able to do it at 5,000 units and still make money.
One of the things that along those lines that I've found with product companies is they focus too much on margin and not enough on cash flow. So they find themselves back to your 3PL where they're out there writing big checks, carrying 6 months of inventory in order to get the margin. And then they're stuck with a bunch of out-of-date inventory, but they look like they're making a lot of money on each one. And I think they focus more on cash flow than on margin.
Right. Yep. Yeah, there's I had when I worked with this company and I was helping them redesign their cost structure, it was a manufacturing company, and I would illustrate the costs are driven by different pieces of the business. For how long is your supply chain? So if you're sourcing product from Brazil and all around the world and bringing it up, into the U.S. and then sourcing it out, the time it takes from raw material to go all the way through your supply chain to your customer is really long, and that's going to drive cost. The manufacturing process, whether you're using mass production or lean, and then the strategy the business has, are you a premium product or a commodity? So there's a lot of different things that drive costs. And then the other thing manufacturing companies get into is that they'll launch product A, B, and C, and it all sitting on, let's say, infrastructure A. So their supply chain, their manufacturing, their warehousing, all kind of has that they'll move along the same supply chain, and then they'll launch another product that they can't manufacture along that same supply chain, and then they end up having multiple supply chains, and so their cost structure goes up because they didn't design products to leverage the infrastructure they'd already built. And so they don't even think about those things. They'll just launch the product, build a whole new, and they're essentially launching a new business to support that new product, and it complicates the overall structure. And then they wonder, hey, how come my margins aren't going up here? And to your point, they have cash flow problems because they didn't really think through what drives cost, what drives the cash flow in this business, and then piggyback on the infrastructure they'd already created.
Rob, this is Taylor. Just a question on the part where you said sometimes you'll have to, or the company will have to cut back or stop any growth on their OpEx to let revenue catch up. What have you seen with some of your clients that have allowed them to do that as they're selling more and generating more revenue? It seems like OpEx, or at least some of the elements of OpEx, will increase. How do they offset that, whether it's increased sales or like customer support or whatever it is that they would have to spend more on? How do they maintain OpEx?
So the key in there is on the R&D side, one. So once you have the MVP of really letting the leverage of, now you have a product that is sellable. It may not be the perfect, what I would call the market fit, but it's allowing you to sell that product into enough customers to let revenue catch up with the product you've already built. So one, you can slow down how fast you're growing R&D and how fast you're trying to get to that perfect product. G&A is the other area to really constrain on and to keep your G&A costs as low as possible. The sales one's more tricky because generally if you're healthy, it's about $1, you're getting a 12-month payback. So if you're wanting to add $1 million in revenue, you need to spend $1 million in sales and marketing to get it. But you could keep that sales team relatively flat and add $1 million one year, add $1 million the next year. You didn't add anything, but you've still added $1 million a year, even though your costs didn't catch up. And so you're taking the infrastructure you've already built and just letting it produce for a while. And so then it naturally, if you freeze cost and you have a system that's generating $1 million a year in revenue, you tack on a couple million more into wherever you're at, and you've now been able to get closer to that break-even point. So some of it's just letting the infrastructure you've built build up the revenue to match that where it's already at. And then you're saying, okay, now let's focus on upgrading the product, going into new product lines. But it's allowing just that period to let revenue catch up with where the infrastructure is already at. It takes a ton of discipline. I'm seeing companies obviously right now with coronavirus where they've had to cut their expenses in half. So they're trying to let revenue grow, but they're also cutting out salespeople, cutting out R&D, which before you just never saw. Everyone, as long as you were growing well, you'd get the funding. And so this environment's changed that a little bit, but it takes a ton of discipline because there's always pressure to grow your cost. So it just takes that. When I was at Instructure, there'd be times where they might do like mini rationalizations where they'd say, okay, for the next 2 quarters, we're not going to hire anyone. We're just going to give 2 quarters. We're going to add some more revenue, not hire anyone, and just let revenue catch up a little bit. And then they'd go back to a hiring schedule. So sometimes it's more dramatic where over maybe 8 quarters, you're holding costs very flat. Other times it might just be, you know what, let's just give this next, 6 to 9 months and let the revenue catch up and then grow for a while. And then maybe you do that again, and it's more staged, letting that happen.
Awesome, thanks. So we're bumping up on our time limit here. So understandably, if anybody needs to drop off, you can. We've scheduled this for about 45 minutes, so thanks for coming. If you've got additional questions, we could probably take another question or two for Rob, if there is any other questions, just quickly.
I have a question. Rob, how do you see companies like Uber tackling what they're facing, like a $5 billion cash burn, while having trouble scaling, especially right now in Corona times? What do you think their next steps would be or should be? And do you think they're going to have issues raising more money in the future?
I haven't studied them specifically, so it'd be hard to have any specific advice for them. But to me, just from the little I know about it, it could be that when they originally just built out their overall business model. Let me bring up this. So if you think of here where we're looking at scale, I always advise clients to think about what does your actual business model look like. And so you kind of phase out of, I'm trying to grow the business, and just looking into the future and saying, at some point when I'm at scale, what is the company's economics going to look like? What can I price at? And just those basic unit economics of saying, where does the company need to be in order to make money, and really analyze that. And I think Uber, I don't know if they do they even have a model that can exist? Have they created something that's stealing market share from the traditional routes, but they're basically put themselves in a position where the only way they can survive is to grow, but they're growing at an unprofitable, and there's really no break even, and there's no profitability point. And so I think the way to avoid that is to, at the very beginning, look and say, where for this company to have good economics and to make money, what would that have to look like? What would my margins have to be at a gross margin level? Where would my infrastructure need to be? And just say, does that business model even make sense? And then I think it gives them something concrete to look at and say, okay, now how do I get from here's startup to that point where the business is at scale and we're making money? So a good formula for that is the DuPont formula, and that's where you take your margin times velocity. So margin being profit divided by revenue tells you how much net margin the company's generating. And then the velocity is how revenue divided by assets. And so then if you multiply those, say a company has a 5% margin and a 2 velocity, they're going to earn 10% return on assets. And so they can analyze their business model by saying, what is my income statement going to look like when I'm at scale? What are my assets and liabilities and everything going to look like? Multiply that and say, is earning 10% enough to cover my cost of capital? Or is this business model really only going to make 5%? It doesn't even make sense to do this. And so I think doing those analytics is saying, what would this company have to look like in order to make money? And so I bet if we were to drill into Uber, we'd probably find, I don't know if you know what their total revenue is now. Do you have any idea?
I'm not sure off the top of my head.
But any business that can't be making money, they probably are at least 100 million, if not billion. I don't know where they're at, but any company that can't make money at 100 million, there's probably something wrong with it, the business model. But
cool, thank you.
Yep.
Rob, thanks so much for your time. This is awesome.
Yeah.
We've been recording it, so we'll be able to share this recording, as well as if you can send me that model, we'll share this out as well to the group.
Yeah.
And we'll be here at the same time next week. I'll send out information about the speaker and make sure we have all the links together. One plug I've got, one of our members, I'm moderating a panel on Thursday with them carry-on intelligence, talking about data in your company. And so I'll include or Michaela and I will include the link to the registration for that webinar. But really appreciate everybody coming, and thanks so much. We'll see you next week. Appreciate your time. Thanks, Rob.
All right.
Thank
Thanks a
you.
lot.
Thanks, Rob. Thanks, Taylor.
Thanks.
Good to see you all.
Thanks, everyone.